Hey everybody, Preston Brent here with our Traders User Group, a weekly roundup. This is for the week holiday ending shortened week, November 27th, 2015. What I've got on the screen here are the E-mini S&P 500 futures, and there's just a couple things I wanted to show you on this. And as I said in the intro title to this update, what does a strong dollar mean for many of the markets? And I've been talking to our members about this quite often for the past 6 months. But I wanted to just give you guys a couple of quick highlights here because should a couple of things transpire next week, then we're going to have a stronger dollar. We've got December the 3rd, which is next Thursday. The ECB, Mario Draghi, Super Mario, is going to be meeting. He's going to be talking about potential more stimulus and what they're going to do with the interest rates over there. That has weakened the euro. And then on December the 4th, that's going to be followed by the U.S. Employment rate. The unemployment was last run at 5%. The estimate again for this next Friday is 5%. But if you guys will recall, the last time we had our employment numbers out, the markets moved dramatically. I think it was over a couple of 100-point move in the day. So we've got a very active week next week where volume is definitely going to come back in. But right now, what I've got on the screen here is the E-mini S&P 500 futures. And I wanted to just show you that, these are just end of day market closes here where we had this nice move up that we've been on really at the beginning of October, and you can see that huge bearish divergence in here. So obviously our group, we were long in this area here, really enjoying it. And then when we took out, there was a little bit of an overhead resistance right in this area right here. And then once we took that out, we were off to the races. So we were adding to longs. I was talking about adding to longs in this area here. And then we topped out right up here. Of course, you never know where you're going to top out. You never know when the markets start coming back down like that, just how far it's going to go. But we ran this Fibonacci from this peak right here to this closing low right there. And we got some common touch points. In a strong market, generally you're going to get anywhere at one of these two fib nodes right here. That you're going to pull back to. Now, 0.236 to 23.6% is not an official fib node, but I use it very often because you can see generally that is an area where the markets tend to find support or resistance depending on the direction you're coming from. And we blew right through it, and then we kind of got stuck right in the middle of the 38% and then a solid 50% fib retracement. And then we started a counter move back up again. And of course, in that counter move, we got a cross in the MACD above the zero line, which gave us a strong move back up like this. Now, what I was telling our members is the odds near term is we're coming into the last 30 trading days of the year or after Thanksgiving and the U.S. holidays here. The markets have shown a tendency to finish strong coming through the end of the year like this. And then, of course, that's what I'm expecting right now, short of any crazy news over in the Middle East or Syria or any kind of potential conflagration, any kind of issues with Russia, Turkey, and all that other kind of crazy stuff that's going on. But here's what this thing is setting up for on a daily chart. Let me just roll it out a little bit so that you can see it a little bit better. You can see right here, we got a pivot high, and now we've got this pivot low, and we're moving up here. So should we come up and take out this pivot high right here, the MACD is probably going to flatten like that and then start to get very weak. That's going to set us up for another daily bearish divergence, which would probably set us up to come back down. And I would guess at a minimum, and again, it's a guess, but testing that pivot low right there. Should it break, then we're going to come down. We got a quick test here, and then we're going to come back down into this area here as we kick off January, February next year. So that's the way the markets seem to be looking right now. If you look at this daily chart, of course, we've got a Fibonacci pattern here. Many of our members are very common with a 3, 4, and then a potential 5 leg right here. And of course, you got the 1 and the 2 leg here. So that gives us the 1, 2, 3, 4, 5 pattern here. And then on the 5th leg, whether the 5th leg is up or down, you set up for that bearish divergence. Then you go into a chop mode. a chop mode, excuse me, either an A, B, or C kind of pattern like that. Now, this is a lot of speculation right here, of course. We take it one bar at a time. For each new bar we get, we update our price data, we update the charts, and it just gives us one more data point with which we can look to see where are the probabilities to the upside or to the downside. Right now, going into the next week, the probabilities still show to the upside. Now, that could change very quickly, but that's what it's showing right now. And the market that is absolutely on fire is the NASDAQ 100 futures. If we look at, let me just find the NASDAQ 100 futures here. You can see right here on this daily chart. Now, I've got all my symbols and everything on the daily chart. You can see here, this red dashed line is the high for 2015 for NASDAQ, and we're almost up there. And again, the same pattern is setting up here, where if we come up and move up, and we do take that high out, we're, the MACD's getting kind of flat, and then it would set up again for a bearish divergence, and boom, away we come back down to this little area right there, which would be a support area that we would probably test. But the NASDAQ 100 futures are the strongest. Now, the small cap, which is kind of measured generally by the Russell futures. If we look at the small cap, you can see this red dashed line is the high for 2015. We're nowhere near that. In fact, if I zoom in a little bit more, you can see this blue dash line right here, 1203.90. That was the opening price of the Russell for the year for 2015. So we're not even there yet. We're still in the red for the Russell. All the other markets are in the green, but the Russell is in the red. And if we look at it, it is very weak. Now, remember, December and January is a traditionally strong series of months in U.S. markets for small cap and mid cap. So I would expect more strength out of the Russell, less upward strength out of NASDAQ, more of a grind in NASDAQ, but really quick moves in the Russell. Should we see the markets go higher? If the Russell gives it up, then I think the other indexes are going to just go flat to down as well. So the key next week is to see how we have a follow-on to the holiday shortened week, and we want to watch very closely small cap, and then probably the mid cap too, as measured by MDY. Mike David Yankee, so or Mike David Yelta Yankee here. So you can see here the mid cap actually started a move. We're kind of challenging the prior high, but we're above the opening price of the year for the mid cap at 265.28. So you can see where you are here. So what I'm going to be watching is the interrelationship next week of the small cap as measured by the Russell futures, the mid cap measured by MDY, and then NASDAQ, the NASDAQ 100. I want to see where we're going to be there. I want to see the small cap as measured by the Russell futures really take off, or IWM if you want to measure that. If we look at the Dow, let me just find the Dow on here. Here are the Dow futures, and you can see on the chart here, the Dow futures are just a hair's breadth above the opening price for the year. You could essentially say we're flat. The other thing with the Dow, you can see here, just like the other indexes, we're setting up here for, trying to take this out, but we got that bearish divergence. So this would tell me that if we do have an up move next week, I think it could be short and shallow before we peel back again and gather some support before we move stronger into December. Now, keep in mind, as I said, December the 4th, we get the U.S. Employment number, 5% is the expected number, but the day before we get the ECB. And these two things here can really move the market. So again, all markets are in the green with the exception of the Russell futures. And if I put the all the color on the screen here and all my price levels and support, you can see this blue dash line here at 2055. So you can see we're well north of the opening price of the E-mini S&P 500 futures as well. Now, what does a strong dollar mean? As I said earlier, well, I wanted to show you if we get this interest rate increase, one thing here that has confounded some people, but I've tried to explain it. Let me see if I can do it again. If we look at the 30-year bonds, look at the 30-year bonds. Since the beginning of October, now remember, October was one of the strongest months in a decade for the S&P 500. October for the equities was up about 8.8%. For S&P, right? Now you would expect if the S&P was up 8.5, 8.8% or so, you would expect bonds would be down. But look at this. Starting in October, bonds have been going in this direction. And you'd be going, what in the world is going on? Bonds, shouldn't they be going in this direction right here, right? This is the as bonds go up, interest rates, remember, as bonds go up, interest rates go down. So shouldn't the bonds, and if we look at this right here, bonds are kind of running out of steam right here. Let me show it. I think another easier way to explain this would be on the interest rates. So if we come to the 30-year yield, here's the 30-year interest rate yield. Let me just get this here so I can move it over on the screen. You can see the 30-year yield has been moving down in anticipation of the interest rate hike on December 16th. But it has not been moving down very far. In fact, if you look at October, and we go into this on a daily basis here, you can see October, we spent a lot of time moving up like this with the huge hike in the equity markets in October, as I said, 8.8%. And just recently, the yield has started coming down, which has been driving the bonds as well. The bond have been moving. So why are bonds moving? Why are interest rates staying unusually low like this, right? I mean, you can see right here, the interest rate yield has been going down. And normally you would expect the interest rates, why aren't they going up like this, right? If the Feds are going to raise the rates, wouldn't you expect the interest rates to start moving up? Well, the reason why we've been having the interest rate yield go down on the 30-year is primarily because money has been coming in from Europe into the 30-year and the 10-year. The 10-year is the same way. The 10-year, although it has been moving a little bit quicker than the 30-year, if you look at the 10-year interest rates, right, you can see back over here in October when the markets were really kind of just going very strong to the upside. You can see right here, starting October the 1st over here to about the 3rd week in October, the yields didn't go anywhere. And then the last couple of days of October, they shot up, but now they're coming back down again. And you would say, okay, why are the interest rates coming down with a potential increase in the yield? Again, on the 10-year and the 30-year, money is coming in to the U.S. from all across Europe. Why? Because the interest rates on government debt in Europe is in some cases, like the German Bund, below zero. So if you say, would I want to have a 2.1% interest rate on a 10-year, like you're seeing here, right? That would be about a 2.1% interest rate. Or would I want to have a 0.4% interest rate on a German Bund? Well, the answer is, I don't want that. I would rather have this. Therefore, this money comes in here and keeps our interest rates lower for longer. Okay. And with the Super Mario looking at raising the rates or increasing stimulus next Thursday, this is going to further exacerbate this problem. So in a way, Mario Draghi is doing a favor to the U.S. Feds by keeping the rates lower. Now, the near-term rates, the 2-year, the 5-year, they're going up. So in anticipation of an interest rate rise. But the further you go out on the yield curve, they're staying steady to flat. So that's what's going on right now. The other thing, with a stronger dollar, you can see the dollar here on this daily chart. Let's just kind of zoom out here a little bit. You can see here, as I said, the dollar is going to come up and challenge this 100 level fairly quickly, should Draghi do that. and then it's going to be off to the races. And if we look at the euro is near a 10-year low. The euro is just coming down right like this right here. You can see. Now, if the euro takes out this right here, I think the odds favor going to parity. This was the lows made early this year in the early part of March of 2015. But you can see this big, huge, rapid move down there in the euro, and the dollar has been going just in the opposite direction. The dollar is really not the dollar currency. It's really the U.S. dollar index, of which the euro represents about 56, 57% of the value. So that's why these two tend to go in the opposite directions. But if I look at this, and let's just step out to a weekly chart of the euro, you're going to be able to see here the euro is caught up in this move here, and my system is indicating the euro could actually come down to about 0.97. I do believe the euro is going to break this 104.7 here, and it's going to come lower. So we've been short the euro. Now in 2016, in the summer of 2016 going out, I think it's going to be a different story. So for our members, I'm going to watch you. You guys should watch. I think there's going to be great opportunities in the euro going long. Now there have been other currencies we've been playing as well, which have worked out. So a stronger dollar is going to be a weaker euro. Now gold has been very weak. Friday it was down 14 points. Let's go back to a daily chart. You can see right here, gold took out this key pivot low here, and we're still going down, and there is no bullish divergence here, guys. My system is indicating gold can come down. I didn't run the Fibonacci extension, but it would put it down here right around $1,000 an ounce. And then I think gold is going to find a bottom and slowly move higher. Why is gold going down? Well, with a stronger dollar, that puts more downward pressure on all commodities in general, but there's no inflation. So gold is going to be down here. But again, coming in 2016, the latter half of 2016, 2017, I think gold is going to be a great play. So for our members, stand by on this one. I think it's going to be good. Same thing with silver. Silver is coming down. It's probably going to come down to my point here with silver down around 1340 area here, and then I think we're going to find some really interesting trades in silver. Also, a strong dollar, what does it mean to the energy market? Right now, oil finished down $1.27. We tried to get a little bit of lift here, but it's just not strong enough. I think oil can come back down even further. I think it's going to take out this pivot low made back here on November 20th, and I'm calling for it to even actually come down and take out a prior pivot low made back in August 24th. Take that out and come down below in the low 30s. That's what I'm looking at oil near term. Now, one other thing I will point out to you guys. December and January tend to be the seasonality where oil and gasoline get stronger. Now, gasoline does not look as weak as oil. Gas wants to move higher. We just took out the 50 EMA. For our members, we've been trading gasoline to the long side. So we're going to watch these two very, very closely here, oil and gas. I tend to be more bullish gas than oil right now. So that's kind of where we're sitting here. Nat gas, because of the warm winter, natural gas is lower than normal. Okay, and I think it's probably going to wallow down around here for quite some time. I've been playing natural gas by selling puts underneath, and I think it's a trade I'm going to probably endeavor to do again as well. So that's kind of where we're sitting right now with these markets. If I just show you a couple of other things that I think are key here, and let me just find it on my screen here. Just a few other things just to kind of reiterate. If we look at the Russell, a ratio chart of the Russell to the S&P 500, you can see as it goes lower, that just shows you the weakness of the Russell in relation to the spiders, the S&P 500. We need to break this here to really get some lift in the equity market. So far, we have not broken it. If we look at a this is even uglier. If we look at a commodity index to the S&P 500, the commodities are in a bear market. I mean, they've just been in a bear market for quite some time. If we come out to a weekly chart, you can see here, look at this, going all the way back to 2008. we've just been going down and down and down. There is no inflation at all. There's so much stimulus going on around the globally with no inflation. That's just killed commodities. Um, so this is also the impact of a stronger dollar is going to impact this as well. The other thing with a stronger dollar is watch for emerging markets. They're going to get even weaker. If we look at emerging markets up here, and if I just put in EEM, which is the ETF for let me just highlight it here, EEM. I'll put it on the screen here. You'll see emerging markets. This is a weekly chart. You can see we broke out of a range that we were in right here. And now we're looking at going even lower. This range right in this area here, boom, we broke it. We came up and we touched it right here, but we couldn't break it, and we're coming back down. This is a 3-leg. 4 here, so I'm anticipating, should we get a stronger dollar, should the euro weaken with more stimulus in Europe and the Feds raise rates, EEM is going to come back down at a minimum, testing this area right here. A lot of emerging market countries are holding debt in US dollars, so higher interest rates make holding that debt more expensive. So these are just some of the things that I see are going to be happening depending on which way the Feds go on Friday and Mario Draghi goes on Thursday. If you saw in the intro to this video, we're running a Cyber Monday special. It's only going to be good on Monday. We're running a special all weekend, but I'd highly encourage you guys to come on in. We're having a fun time in 2015. I think 2016 is going to be even more fun from a money perspective because there's going to be some great trades setting up. Because when you get dislocations in the markets like this because of all the stimulus, it just creates some great swing trade positions, trades that run 4 to 8 weeks, especially in the commodity market. So guys, I hope you're having a great weekend. For those of you in U.S. markets that are enjoying the holidays, relax, eat a lot of food, and just as a reminder, we're off Sunday night. We'll pick it back up with our Tuesday morning pre-market trader session. For those of you that are non-members, highly encourage you to come in and take us up on that offer, that Cyber Monday offer. All right, everybody. And it also comes with 2 free coaching sessions. So I can quickly give you an analysis of what you're doing and how you're doing it, and hopefully get you squared away going into December, into next year. All right, everybody. Have a great weekend, and I'll be in touch. Bye now.